Let's bring Abigail Doolittle into this conversation, as we do every day at this time, for our Options Insight segment. And speaking of options, Abigail, I'm told that we have a big expiration this Friday. Is that a big part of the reason we're seeing these kind of moves?
We do indeed.
Yeah.
And it's interesting only because back in March when we had that brief rally within this year's downtrend, it was also an options expiration week. Yeah. And our next guest, Kevin Kelly, at that time told us it was going to continue. This time, though, I'm told it's different. Let's find out more. Kevin Kelly of Kelly ETFs, great to have you with us as always. And Kevin, it's so interesting because it feels as though the ground is set for at least some sort of slightly sustained bear market rally, but it sounds as though you think that this may be, I don't know if it's a couple days higher, or what do you think?
Yeah, I think given that it's options expiration week and we've had low volumes coming into it, trading volumes coming into it, and we're seeing actually a lot of the open interest is around the 4,000 level and we're above that you can't really decipher and take big moves going forward from what the VIX is telling you today, right? The VIX is saying we're going to get 1.6% moves going forward over the next 30 days. But if you actually look at its brethren, right, if you look at the VIX 3 months or you look at the VXN, which is the Nasdaq 100 VIX, it's telling you actually that there's a lot more volatility to come and potentially further downside in the market. So you may get some reprieve over the next couple, throughout the next couple days into that options expiration, as well as maybe even the first couple days of next week. But watch out, because the VXN and the VIX 3 months is telling you that earnings are going to be very, very uncertain. And so that may lead to further downside.
So maybe we get a true summer correction of some sort, but maybe, as you're talking about, a few more days of reprieve. And if we bring the Fed into it, because of course Fed Chair Jay Powell out today having a pretty strong stance, and it was interesting, stocks came off the highs initially, but now we have stocks up even more than ahead of those fairly hawkish comments. If we go into the Bloomberg terminal, it's all about the Fed liquidity, and it's interesting to see the divergence that we have right now between the balance sheet and the S&P 500 ahead of QT officially starting. Do you think that this could be a continued source of volatility?
Yeah, so what you have to think about is that when the Fed was going through quantitative easing, we entered into a new volatility regime where realized volatility was compressed because the Fed was artificially manipulating the fixed income markets to spur risk. What are they doing? The exact opposite. They're trying to take risk off. They're removing and shrinking their balance sheet. So we're going to enter into a new regime where it's going to be more volatile. The way to think about this is everyone's talking about PE multiples. Oh, you can buy the market today at 16 times earnings, and that's a historical average. Well, in the previous volatility regime, we were buying earnings at 21 times, 5 points higher. Can it be the opposite going forward when the Fed is actually removing liquidity from the market? Could we actually trade at an 11 multiple? We don't know because we've never been there before. You can't look at pre-2008 when the Fed came in and started increasing their balance sheet and look to that as a guide. You actually have to look at what happened in the previous regime when the Fed was easing and look for that to give you tails going forward when they're tightening. So a 16.5 multiple going forward really tells you nothing when there's a lot of uncertainty around, European recession.
Right.
You see commodities go through the roof. So I think we need to be really careful here with what the Fed's doing.
Great perspective as always. Kevin Kelly of Kelly ETFs. Thanks for joining us today for Options Insight. And from New York, this is Bloomberg.